So, welcome to our financial plan. In this section, we've developed our break-evens for all three entities of the business, the crops, livestock, and custom work. And we've also included our projected cash flow, income statement, and balance sheet for the first 3 years. This information has made it possible to generate the income statements from the cash flow and also the balance sheet. So in this section, we'll explain the financial aspects of the business from purchasing of the land to explaining our raw numbers. And please refer to the attached spreadsheet up there for all financial documents. So we'll get right into it. For the land and the buildings, we've chosen to purchase an already established farm in the Kneehill County region of Alberta. This county is highly productive in crops, and that reflects in the price of land. And approximately right now, the estimated value of land is $3,000 per acre. So this price reflects the large sum of $6 million needed to purchase the 2,000 acres. The additional $400,000 in buildings represent the farm buildings, such as houses, machine sheds, Quonsets, and also storage such as grain bins, which are needed for the operation to function. To finance this large purchase, we've decided to use the $2 million we inherited as a down payment in order to borrow the remainder amount. This will be financed through Farm Credit of Canada, and will be paid an annual payment at 4% interest rate over 29 years. And we've also attached the Farm Credit Canada overview of the loan, which summarizes it. And also we've attached the actual payment structure for the whole 29 years. Moving on to equipment, we've attached a list of equipment we plan on purchasing. We've determined to buy used and finance the purchase, as it will enable us to cover all our operational needs. This will also increase our cash flow due to less money being tied up in equipment. We've chosen to make the 20% down payment, which is required by FCC on used equipment, and that's going to be amortized over 10 years, which is the maximum they allow, at again a 4% interest rate. We've also again attached the overview of this loan and the full payment schedule as well. So moving on to the financials, for the break-evens, we've estimated our projected incomes for all three entities, the crop, cow-calf, and the custom work. So for the crop break-even, a price and yield matrix has been developed in order to estimate the probability of prices and yields for all four crops that are going to be grown on the land. These matrices enable us to get a best guess for the actual numbers and gives us a bit of a wider spectrum to work within. The expenses have been taken from the Alberta government website, which looks at an average for the soil zone we'll be farming in. These are conservative numbers, since expenses such as seed, chemical, and fertilizer tend to be cheaper with the more you buy. And also factors such as loyalty discount, customer discount should also be taken into consideration. The cow-calf break-even is kept very simple, and again provides two key matrices to estimate the prices of bred heifers and bred pairs at auction. For expenses, the bred heifers have been included since they'll be sold within the year, and we won't retain ownership of those heifers, and therefore they can't be listed as an asset. All other expenses has been taken at an estimated projection as a whole, and divided over the number of head we choose to run. And lastly, the custom work break-even. That's been split into the four operations we plan on offering: seeding, spraying, swathing, and harvesting. These rates will be charged. The rates that will be charged have been taken from the Alberta average for the 2013 season. So, moving on to the cash flow. The cash flow for the first 3 years have been broken down into sections to simplify the flow and appearance of our financials. The two sections, cash flow in, cash flow out, have been split into three categories: operating, financing and investing. The cash flow demonstrates an equal trial balance for all 3 years and also shows positive cash numbers for each month of the year. It appears we have a lot of cash on hand at the end of the year, and this is due to our land and equipment payments being deferred till January. Also, the cash flow shows that our line of credit, which acts like our operating loan for us, is paid off in December. This allows us to clear our line of credit for the following season and gives us extra security for unseen events, such as equipment breakdown. So moving on to our income statements. Our income statements, again, are broken down into the 3 entities and other expenses that could occur. We feel that this is a good way to evaluate how each entity is doing when looking at revenue versus expenses. This breakdown also enables us to see where the adjustments could be made when making decisions on expanding specific entities. As one can see, we've projected a net income that exceeds our goals we made prior. However, this number should be taken conservatively since major payments haven't been accounted for yet, such as landlord payments. And lastly, our balance sheets. So currently our balance sheets are equal in the total assets and the total liabilities and equity columns. This is exactly what we're looking for. And as you can see, again, we have a lot of cash on hand, and usually you want to put that somewhere, such as paying off loans to reduce that liability. And we'd be looking at that. However, this is just to get the ball rolling and see if it's actually feasible to do. And looking at our financials, you can see from our break-evens, from our cash flow, all the way to our income statements and balance sheets, that this is a profitable enterprise, and that there should be no reason why it shouldn't work. So overall, we've gained a positive cash flow, and also we've proved that even over 3 years, it could be a very profitable enterprise.